This is the Quintarth Weekend Market Recap for the week ending August 24th, 2026. Our briefing covers three specific parameters: macro shifts in inflation and tariffs, the mechanics of digital asset yields, and traditional Canadian tax shelter strategies. Navigating these developments requires mapping targeted economic shocks and performing precise yield math. This split chart isolates the latest inflation data. Statistics Canada reported on August 17th that the Consumer Price Index rose 3% year-over-year in July, the top of the Bank of Canada's target range. The driver was gasoline, up 25.7% year-over-year, after a 20.5% rise in June, under pressure from the blockade of the Strait of Hormuz and the partial closure of Red Sea shipping routes in late July. Adding the secondary data points to the chart shows what kept the picture from being worse. Core inflation held near 2%, and grocery prices rose more slowly, with food purchased from stores up 3.1%, after 3.9% in June. Moving to trade, negotiations with the United States broke down late on Friday, August 21st. The United States imposed 50% tariffs on $20 billion of Canadian goods. That is roughly 5% of what Canada ships south each year, covering products as ordinary as hockey sticks and tongue depressors. Speaking on August 22nd, Prime Minister Mark Carney said Canada had been willing to drop its remaining retaliatory tariffs on steel, aluminum, and autos if the United States lowered its own. Noting the American demands went too far, Carney stated, "They asked too much and offered too little." Canada will match those tariffs dollar for dollar beginning September 8th, targeting American steel, dairy, appliances, agricultural equipment, pulp and paper, and electronics. A headline driven by an energy supply shock while core holds near target is a different situation from broad inflation reaccelerating, and the macro picture should be described as a series of specific, targeted shocks. Bloomberg reported on August 23rd that gold bullion traded above $4,620 an ounce, near a 3-month high, marking a third consecutive weekly gain. This timeline maps the exact reported cause. Announced on August 19th, the U.S. Treasury said it would double its buybacks of long-dated government debt, running from September 9th to November 4th, to hold borrowing costs down. Intervening directly to hold borrowing costs down pushed yields and the dollar lower. This specific Treasury operation revived what markets called the debasement trade, which is the move into tangible assets when confidence in paper money softens. We turn to digital assets. This comparison table establishes the baseline yields given up by holding unstaked crypto. Solana staking pays about 6.5% a year. On a $100,000 holding, at that rate, that is roughly $6,500 a year, or about $542 a month, given up by not staking. Polkadot's active nominating yield is higher, at about 13.5%. On a $25,000 position, at that rate, that is roughly $3,375 a year, or about $281 a month. Avalanche pays about 7.5% a year in native staking rewards, distributed roughly every 14 days. On a $50,000 position, at that rate, that is roughly $3,750 a year, or about $313 a month. Where a staking yield is held changes what is left of it, because Canadian staking rewards are taxable as ordinary income when earned in a non-registered account. Purpose Investments raised the staking on its Solana ETF to 8% gross in April 2026 and passes that through to unit holders, and a Canadian-listed ETF of that kind can be held inside a registered account. On a $50,000 position at 8%, that is $4,000 of gross yield. Assuming a 33% marginal rate, roughly $1,320 of it goes to tax in a non-registered account. That marginal rate is strictly an assumption for this worked example, not a fact about any particular person or personalized advice. In digital assets, the quoted yield is secondary to the final net return dictated by the specific structural mechanics of the chosen tax vehicle. In traditional Canadian personal finance, a GIC inside a TFSA spends the shelter on an asset that cannot compound hard. A $50,000 GIC at 4.5% grows to roughly $77,600 over 10 years. That is the whole return. A GIC pays its stated rate and nothing more. The question worth asking is not whether that rate is good, but whether a tax shelter is the right place to hold an asset whose ceiling is fixed in advance. Those are the essential market data points for the week ending August 24th, 2026. Thank you for joining us for this Quintarth Weekend Recap.